While we anticipate positive global growth in the first half of 2025, the second half is uncertain and will be influenced by US policies under the Trump administration and potential Chinese stimulus measures, possibly in reaction to US actions. If the incoming Trump administration enacts policies like lower taxes, reduced regulations, and trade tariffs, these measures could be inflationary and impact global growth eventually. China's near-term uncertainties call for caution, but we believe that the long-term growth prospects remain strong. India too remains a bright spot in the long term. Some ASEAN countries are also expected to have strong fundamentals and may outperform China in growth and foreign investment. While 2024 saw the beginning of the Federal Reserve's easing cycle, the inflation outlook for 2025 is less clear, suggesting that the pace of rate cuts may be tempered and the Fed's terminal rate could be higher than initially expected. Despite this uncertainty around the new US policies, earnings will be the primary driver of asset prices. Increased capital expenditure, infrastructure investment, and decarbonization, and indeed supply chain diversification, could all lead to higher earnings in emerging markets. The rise in Treasury yields since early October has increased the attractiveness of US-denominated credits. Asian currency bonds fully hedged to US dollar can boost overall portfolio yields due to the carry advantage from a cross-currency basis. Diversifying sources of returns is more crucial than ever, as we expect more volatility. Defensive strategies such as low volatility, dividend income, and multi-asset investing can help cushion against downside risks and contribute to more stable returns. Although the new US policies could pose challenges for Asian and emerging markets, their long-term structural growth drivers, attractive valuations, and the relatively defensive nature of ASEAN markets still offer opportunities for long-term investors. China, India, and Japan could merit standalone allocations due to their unique opportunity sets. Picking the right entry points and selecting stocks with visible earning growth drivers could be key, rather than simply chasing those markets. We prefer high-quality bonds as spreads are historically tight and we're approaching the end of the current economic cycle. With the US having been a significant contributor to growth in 2024, global growth may be affected by reduced US consumer spending from decreased savings and lower wages. Market disappointment over rising inflation, the path of US interest rates, and a stronger US dollar can impact asset prices. Lastly, geopolitical events can greatly influence investor sentiment and should not be underestimated.
投资一定有风险，基金投资有赚有赔，申购前应详阅公开说明书或投资人须知。
While we anticipate positive global growth in the first half of 2025, the second half is uncertain and will be influenced by US policies under the Trump administration and potential Chinese stimulus measures, possibly in reaction to US actions. If the incoming Trump administration enacts policies like lower taxes, reduced regulations, and trade tariffs, these measures could be inflationary and impact global growth eventually. China's near-term uncertainties call for caution, but we believe that the long-term growth prospects remain strong. India too remains a bright spot in the long term. Some ASEAN countries are also expected to have strong fundamentals and may outperform China in growth and foreign investment. While 2024 saw the beginning of the Federal Reserve's easing cycle, the inflation outlook for 2025 is less clear, suggesting that the pace of rate cuts may be tempered and the Fed's terminal rate could be higher than initially expected. Despite this uncertainty around the new US policies, earnings will be the primary driver of asset prices. Increased capital expenditure, infrastructure investment, and decarbonization, and indeed supply chain diversification, could all lead to higher earnings in emerging markets. The rise in treasury yields since early October has increased the attractiveness of US-denominated credits. Asian currency bonds fully hedged to US dollar can boost overall portfolio yields due to the carry advantage from a cross-currency basis. Diversifying sources of returns is more crucial than ever as we expect more volatility. Defensive strategies such as low volatility, dividend income, and multi-asset investing can help cushion against downside risks and contribute to more stable returns. Although the new US policies could pose challenges for Asian and emerging markets, their long-term structural growth drivers, attractive valuations, and the relatively defensive nature of ASEAN markets still offer opportunities for long-term investors. China, India, and Japan could merit standalone allocations due to their unique opportunity sets. Picking the right entry points and selecting stocks with visible earning growth drivers could be key, rather than simply chasing those markets. We prefer high-quality bonds as spreads are historically tight and we're approaching the end of the current economic cycle. With the US having been a significant contributor to growth in 2024, global growth may be affected by reduced US consumer spending from decreased savings and lower wages. Market disappointment over rising inflation, the path of US interest rates, and a stronger US dollar can impact asset prices. Lastly, geopolitical events can greatly influence investor sentiment and should not be underestimated.
投资一定有风险，基金投资有赚有赔，申购前应详阅公开说明书或投资人须知。
While we anticipate positive global growth in the first half of 2025, the second half is uncertain and will be influenced by US policies under the Trump administration and potential Chinese stimulus measures, possibly in reaction to US actions. If the incoming Trump administration enacts policies like lower taxes, reduced regulations, and trade tariffs, these measures could be inflationary and impact global growth eventually. China's near-term uncertainties call for caution, but we believe that the long-term growth prospects remain strong. India too remains a bright spot in the long term. Some ASEAN countries are also expected to have strong fundamentals and may outperform China in growth and foreign investment. While 2024 saw the beginning of the Federal Reserve's easing cycle, the inflation outlook for 2025 is less clear, suggesting that the pace of rate cuts may be tempered, and the Fed's terminal rate could be higher than initially expected. Despite this uncertainty around the new US policies, earnings will be the primary driver of asset prices. Increased capital expenditure, infrastructure investment, and decarbonization, and indeed supply chain diversification, could all lead to higher earnings in emerging markets. The rise in treasury yields since early October has increased the attractiveness of US-denominated credits. Asian currency bonds fully hedged to US dollar can boost overall portfolio yields due to the carry advantage from a cross-currency basis. Diversifying sources of returns is more crucial than ever as we expect more volatility. Defensive strategies such as low volatility, dividend income, and multi-asset investing can help cushion against downside risks and contribute to more stable returns. Although the new US policies could pose challenges for Asian and emerging markets, their long-term structural growth drivers attract.
Good afternoon, ladies and gentlemen. Welcome to our 2025 Market Outlook Seminar. The event will begin in 5 minutes, so please take your seats promptly. And also, for those who are still outside this meeting hall, please come in and take your seat. To ensure the smooth progress of the program, kindly set your mobile phones to silent or vibration mode. Thank you for your cooperation. For guests using simultaneous translation devices, please select Channel 1 for Chinese and Channel 2 for English. And we also encourage you to complete the feedback survey in your welcome packet. Return it to the registration desk after the event to receive a complimentary issue of CommonWealth Magazine. You can also find the QR code on the back of your badge, and you can also fill in the feedback survey online. And lastly, after today's event, please show the feedback or the paperback feedback to the registration staff in exchange for a complimentary issue of the magazine. Also, feel free to submit your questions using the provided forms. Each session will have a 5-minute Q&A, and selected questions will be addressed. Our staff will collect the question sheet 10 minutes after each session begins. You can also use the QR code, scan the QR code, and submit your questions online. We will try to address as many questions as we can after each session of the presentation. After each session, we will have a 5-minute Q&A, and we will try to address your questions.
The Eastspring Investment Outlook 2025. Our forum will commence in 5 minutes, so please kindly take your seats. And also please switch your cell phone to silent or vibrate mode. And also for our guests who are using the simultaneous interpretation headset, Channel 1 is for Mandarin Chinese and Channel 2 is for English. And also we encourage you to complete the survey, which is in your packet, the welcome packet. And also you may also scan the QR code on the back of your badge to submit the survey online. And lastly, please feel free to submit your questions using the provided form and the welcome packet as well. And also you may also scan the QR code and submit your question online. We will have a Q&A session during each presentation. So don't forget to submit your questions. And today our forum will commence in 5 minutes. Thank you for joining us today.会选吗？可是我刚不选。好，各位贵宾，大家好，我们今天。
Ladies and gentlemen, our forum will begin shortly. Once again, please allow me to remind you that you can submit your questions after each session begins. Our staff will collect the question sheet from you periodically. You can either write it down on the question sheet or submit the questions online. We welcome you to raise questions to our speakers. Each speaker will have a 5-minute Q&A after their presentation, and we will collect question sheet from you and try to address as many questions as we can. Thank you. Good afternoon, ladies and gentlemen. Welcome to the 2025 Eastspring Investment Outlook Forum, Opportunities Amid Shifting Tides. I'm your host, Rebecca. As we step into the uncertainties of 2025, Eastspring Investments remain steadfast in journeying alongside our investors. While markets grapple with disappointment over rising inflation, ambiguous trends in U.S. interest rates, and strengthening U.S. dollar, resulting in heightened volatility. But we believe that long-term growth drivers such as increased capital expenditure, decarbonization, and supply chain diversification still present a shining opportunity in Asia and emerging market equities. And beyond equities, high-quality corporate bonds stand out as a reliable source of income under the overarching theme of rate cuts. So today, Eastspring Investments, in collaboration with CommonWealth Magazine, is proud to host this investment forum featuring a stellar lineup of speakers and several distinguished guests in attendance. Together, they will provide you with fresh investment insights, empowering your asset allocation to forge ahead through challenges. Let me introduce our esteemed speakers and their titles in the order of seating.
And our speakers who are here with us today. Please wave your hands as I mention your names. 那首先呢，我们要欢迎汉雅彤。
Well, first of all, Ms. Alice Lee, Head of Channel Distribution of Eastspring Taiwan. Next, Ms. Polly Wang, Head of Greater China and CEO of Eastspring Taiwan. Welcome. Next, Mr. Li Yuan Chen, Head of Product, Marketing, and Direct Distribution of Eastspring Taiwan. Ms. Rebecca Lin, Head of Investment of Eastspring Taiwan. Say hi to everyone. Next, Mr. Visnayar, Chief Investment Officer of Eastspring Singapore. Next, Mr. John Lin, AVP and Fund Manager of our Eastspring Indian Equity Fund. And finally, Ms. Claire Huang, Head of Client Portfolio Management of Eastspring Taiwan. Welcome. Welcome to all of you. Each one of them will delve into topics such as market outlook, bond markets, and Indian equities, equipping you with insights to seize the opportunities of 2025 amidst the waves of transformation and grapple with the opportunities. And before we begin, I would like to welcome Ms. Polly Wang, Head of Greater China and CEO of Eastspring Taiwan, to deliver the opening remarks. Please join me in welcome Ms. Polly Wang. Distinguished guests, ladies and gentlemen, here and also online, good afternoon. I'm very pleased to have this opportunity to host this Outlook Forum in collaboration with CommonWealth Magazine at the very beginning of this year, and to share with you our views for 2025. First of all, I wish you a very happy new year. Looking back at 2024, U.S. continue U.S. economy continues to show resilience, and the Fed started the rate cut cycles. And with abundant optimism, global equities delivered very strong return throughout the year. But what about 2025? Most people believe that in 2025, we will see a lot of challenges, increasing volatilities. But we do believe that Asia and emerging market equities have a great potential in terms of upside. And with the support of rate cuts, we believe that we will be able to seize the opportunities of both defensive and income investments. Today, we are very pleased to have our Chief Investment Officer, Ms. Noyar, to come to Taiwan from Singapore to share with us his views on the market. And this is the first stop of his road trip worldwide. And that shows how important Taiwan is to Eastspring. And this also echoes to the FSC's requirement that we would like to become the asset management hub for Asia. And this is going to share with us the first-hand outlook for Asia and global economy. Protecting the wealth our clients is our most important mission. Whether it's short, mid, or long term, our products continue to deliver outstanding return. We have a strong team, and last year, once again, we received a number of awards, industry awards and recognitions. For instance, our equity investment team received Asia Asset Management's Best Equity Team, and our Japanese equity strategy and team also received benchmarks reward. So looking ahead to 2025, maybe we're going to see more challenges and volatilities. However, at Eastspring, we will be steadfast with you, continue to seize opportunities with you. Finally, with the approach of the Lunar New Year, I would like to wish you all the best and all the good health in the year of Serpent. Once again, thank you for joining us today. Thank you, Polly, for your opening remarks. So today, we are going to show you the investment opportunities that we see in 2025. And now, as we look ahead to the uncertainties of 2025, major events such as the aftermath of U.S. election and the strengthening U.S. dollar, it will undoubtedly have a significant impact on the year ahead. So today, we are very pleased to have Mr. Vis Noyar, Chief Investment Officer of Eastspring Investments Singapore, to share with us his views on the global economy.
Look, welcome, Vis.
Thank you. You can hear me now. Thank you. Thank you all very much for coming today. I'm very, very honored to be here, as Polly described. It's the first presentation of the year, so I'll apologize, and any complaints, you tell me straight away if it's a challenge. It's the very first presentation of the year. I think Polly already mentioned some of the highlights of the outlook itself. We are very clear that we have arrived in 2025. We've seen two particularly strong years in global markets, particularly driven by the US. I think you see this phrase, US exceptionalism, and it's really been driven by the growth in the US, particularly by the US consumer. Now, when I do the presentations, these graphs are just, broadly just messaging what we are seeing. But really the key thing, and Polly mentioned this, the key thing is that we see 2025 as being a little bit more challenging for global markets. We've seen 20+% returns for 2 years, and that will be quite a challenge to repeat. I feel I should pause for the translation. I think we're good. So when we think about this, look, the two key things here, you've got the PMI telling us that US has done well, but it's likely to slow down. And then we had this narrative. These slides were done towards the end of 2024, but Donald Trump had just won the election. And very clearly, the message was that for the next 6 months or so, the campaign trail had talked about policies that we worry about, things like inflation. But clearly, it was as you were. There was no risk of this US recession. We'd spent 2 years worrying about hard landings, and then it was soft landing, and then it was no landing. And the US has powered ahead. But undoubtedly, one would worry that policies can boost in the short term. But the key thing is, what do we worry about for the rest of the year? So as I mentioned, US consumer is key, absolutely key. So they have, the narrative around the savings from the lockdown, they have continued to spend. The US economy is going at absolutely the top end of sustainable growth. Unemployment is low. A full-featured economy really starts worrying investors when we look forward. So we can see that wage growth is moderating, but clearly the Fed's going to have to pay attention to that, because this driver of global growth of the last 2 to 3 years is going to start fading a little bit as expected rate cuts and the like start to get challenged. So inflation has been trending down. That was the message at the end of last year, but those who follow the news in the last couple of days would see that the numbers are starting to disappoint again. And again, this is evidence. This graph was done towards the end of last year. Long end of the rate was sitting around the 4.5 mark. Yesterday, they breached 4.6. We mustn't forget that in 2023, not a long time ago, those numbers were hitting 5. Therefore, the challenge for us is very much that is an environment where the Fed is going to struggle to really bring down those rate cuts. And I probably mentioned those rate cuts, but those rate cuts are going to be a little bit more challenged than perhaps pre the Trump win. Now, another thing I want to raise, we talk about these concerns and worries in the global market. Jerome Powell has clearly got to pay attention to the inflation environment in the US. We know that in Trump 1.0, there was quite a lot of debate between the president and the head of the Fed, really chairman of the Fed, around policies that would protect the dollar and policies that kept interest rates low. So potentially that was also a friction coming into this year. But the Fed chairman is not going to stand for re-election in 26. So we feel that he's quite empowered to deliver that inflation mandate that the Fed stands behind and has done for so long. So potentially that's another risk for us, because the expected rate cuts that were in place before the election have started to wane, and that becomes a really big risk into the second half of the year. So Polly mentioned this risk, and I think risk is one of those key messages around this year. Now, China, we do some data on China, but I was just finishing the numbers at the end of the year. So I've been asked to slow down a little bit, so I just pause. But as we look at China and the data of China, one of the incredible data points is China outperformed India in 2024 as an equity market. So all of the noise still gave us a positive stock market return. But if we look into the year, most of that stock market return was in August to September, and we think of that number as being about 30%, but the annual return was 15%. So you can do your own math. So the rest of the year was generally quite painful for investors. The reason why we put it here, we think fiscal policy continues to be a wild card. And the thing we learned from 2024 is that you don't simply want to be uninvested, but you need to be very thoughtful around how your exposure is set up. EM, we talk about EM in general, and of course China is a big part of EM, but selective EM, selective investing in EM becomes key. So we've had a very difficult year for EM because of the strength of the US dollar. Now, again, if I reflect back on my own learnings, Trump 1.0, he was very, very keen on a strong US dollar. He talked about it a lot. He felt it was sort of national importance. What's clear this time around is that he is more interested in trade. He seems to talk a little bit more about foreign agents exploiting weak currencies, which makes me think that he's a little bit more interested in where the dollar trade against its main trading partners, and that potentially opens up a better environment for emerging markets. Despite that, I think that it's really important to be selective. So we've just seen that Argentina has done very well, but Brazil has had a really difficult time with its fiscal policy. You have certain potential supply chain diversification benefits into Eastern Europe, but we've seen some challenges in China, for example, in Asia. So investing in EM still is access to greater growth in a world where we worry about US growth, we worry about European growth. So it's still the channel to growth, but we want to be super careful about where we invest and be selective about the countries we invest in. So I've talked about investing. We ought to try and share some ideas. How are we doing for speed? Translation going well. So I always have this slide after the last slide, and I feel that I'm repeating myself. But the key thing about emerging markets is just how cheap they've become. There's been a number of headwinds. Do not forget, China is a large part of this index, and so it has a big effect on the falling value, the relative value. But emerging markets are exceptionally cheap. There are great investment opportunities. We all know that the investment story of the last 2 to 3 years has been the US, and it's been about these small groups of names that have incredible leverage, right? These AI companies have been able to grow very, very rapidly, acquire customers at very low costs, and really benefit. That has left behind a large number of stocks and companies across the globe that potentially are very interesting now. And we talk about active investing. My own take on this is that the indices in emerging markets have not delivered very much. So if those who have done analysis of India and China will show that they go in opposite directions and have done for a number of years. So if you're just investing in that index, you're not being selective enough to benefit from this possibility. So active investing, finding those active positions, those active companies, those are the ways to try and outperform. So I was looking at my investment team. I've been at Eastspring for 6 months. And my first challenge was to talk to the teams, to have a look at their investment processes, to look at how they identify securities. We have a value team that was overweight China, naturally, in 2024, and they benefited from being in the right names. The growth strategies were underweight China, but they picked the right stocks. So being overweight China helped last year for the value strategies, because China did well. And the growth strategies were underweight China, but they also outperformed because they picked the right stocks. So there's different ways of seizing the opportunities in emerging markets. And I think that it's such a key thing. I think indices are going to be finding life a little bit more challenging in the coming years. I think I've repeated this enough, cautiously optimistic. The message from last year very much is being completely uninvested might not be good for you. So you need to be thoughtful. Timing when the policy comes and the velocity and importance of that policy is probably a very, very big challenge. And so being thoughtful about being invested is a good idea. India is, of course, a very historic heritage for Eastspring. And the Indian market has been very, very strong for a number of years. In my career, I've been based in London most of my career, but we've seen the trade on India for the last 3-4 years. And it's one that's very well established. And it's been a real change. We've seen a change in the way India is viewed. So 20 years ago, it was these global companies, large cap Indian names, that were benefiting from globalization and offshoring effects from Europe and US and things. They did very well. What we're seeing in the last 2 to 3 years is small and mid caps focused on the domestic economy, and they've done and rallied really strongly. As we stand towards the end of 2024, I think there's a general feeling that the valuations in those smaller mid-cap names have certainly got quite overvalued versus the larger cap names. So again, it's a principle of active investing. Our own India investment process, India investment portfolios, tend to be all cap, and we tend to also have those opportunities in the Indian large caps that we think will give us those added alpha in the coming year. It's very interesting for us around how we put that in, and of course our PMs will go into that in detail. But certainly those large cap, the correction that we saw towards the end of 24 has brought up some really good and interesting value opportunities for the India large cap. Finally, we also, I came from somewhere, I've not seen Japan active and not much interest in Japan. for many, many, many years. I see Japan becoming so much a big market and such a big opportunity now. Polly, we talked about diversification in a world where we worry a little bit about risk and volatility. Japan looks like a standout diversification opportunity. The narrative around the market there is that ROEs have improved in the large cap names. We know that the BOJ's rate cycle, while challenging, is a very different place to the US. We see this profitability increase as a team. We see that broadening in the Japanese market. The politics of tariffs and the like, I go into that a little bit by saying, my take is it's very much that you'd rather be a friend of the incoming administration than one of the countries that they're very challenged with. And Japan seems like it's in the best place for many of those things. So our own portfolios, we're in Dynamics Funds is a broad cap strategy, and they've been rotating away from some of the largest names into these opportunities that they see in smaller and mid cap. And really it's that broadening of the Japanese story that we think will be the big debate for 2025. And again, a really interesting opportunity as we talk about diversification. When you go into fixed income, we mentioned earlier, the curve, it was our take into the election was to be quite defensive. We took duration off, and we were worried a lot around the position as Trump came in. And that's because the rhetoric in the election campaign trail was very much around inflationary policies. And we worry a lot about that as a bond investor. So we've seen that come through. We've seen the rates go up to 4.6% yesterday. That is a challenge. And again, our take is that taking on duration, you want to do it tactically. You want to seek out those opportunities actively to add duration when the opportunity presents itself. And again, Asia and EM, this is such an opportunity for us as investors. Asia and EM currencies, non-US dollar, seems less sensitive to that risk. So again, there are interesting pockets globally for us to take opportunities, and the key message is diversification. You have to seek out far and wide to find the best opportunities this year. Again, in fixed income, we also want a key message around quality. Quality bonds are absolutely, in our view, the place to be. And I can't plan these sort of presentations, but of course yesterday we had the news that defaults were slightly up in the US. Interestingly, the markets seemed to just glide past that. They didn't really worry about it, but that's an exceptional market that we see. But these data points around defaults going up are going to become very painful if that continues. So I think this message around staying in quality is key for us as well. Again, we talked a little bit, moving shift around what other opportunities can you use in diversifying your portfolio. So first one we're going to show you here is the low volatility strategy. In my own career, I probably first started doing these strategies more than 10 years ago. And there are periods when there are exceptional opportunities, and there are periods when they're less so. So if we really are expecting stock market returns of 20%, low volatility isn't exactly where clients want to be. But as we move to an environment where stock market returns are looking more challenging, we're talking about this volatility, we're talking about risk, this is an exceptional opportunity, both in Asia and global. And again, knowing my audience, I'm sure you're all very, very familiar with these sort of strategies, but they can deliver great risk-adjusted returns, great yields, and they also diversify your portfolio because the risk shape is very different. So in a world where we've been taking on the risk of tech, which is very high duration equities, long-term growth, long-term terminal value, these sort of low volatility strategies tend to be much less exposed to some of that. So it's a very interesting addition. So again, it's a nice, we think, interesting strategy. The other thing that's worth mentioning is that in 2024, I was surprised by this. In 2024, low volatility was a risk premium that was positive. There wasn't much that happened in 24 that would make us predict that. So I think that the market of these low vol stocks have developed in the last decade or so, in the sense that in a very benign, relatively benign market in 24, they delivered positive returns. And of course, when we look forward into 25 and 26, we expect more volatility. We would really expect them to do better in the coming year. So very, very interesting capability. The other thing, of course, is income. I'm in Taiwan. Taiwan is very, very popular. I think income strategy is very popular in this market. And for good reason. I think it's be a good place to be as we look forward. Again, in the portfolio, a diversifier. So, I mean, I've just seen clients and people are always asking about US tech, US exceptionalism. Is that going to continue? And when we think about these sorts of strategies, what we're constantly, the message I want to get across is we're talking about diversification in the face of this volatility. So these small group of stocks, the concentration in the likes of the US, will likely create some turbulence and some vol. And so we are presenting a number of different strategies we think can help your portfolios with that challenge. Last but not least, we talk about thematic. Again, as an investor, you know, a lot of the Europeans, I used to be based in London, a lot of the European managers have been dealing with thematics for a number of years. We see different cycles. So there was a very early cycle of thematic, which was, you know, lasted 20 years ago, and they kind of didn't raise very much, and they were not very well structured. The second theme of thematic, second cycle kind of ended in 21 or so, 2020, 21 around COVID. Again, because a lot of ESG type measures that people launched, and then they weren't long-term and they weren't robust. Thematics have to have a long-term story. Otherwise, we're not here to buy investments that are, you know, have a 6-month duration or a 12-month duration. So one of the things we do at Eastspring is to really start thinking, you know, I've arrived in one of those things that we're trying to do, thinking about the long-term trends in markets that we think we can exploit. So that first one, we talk about transition. But I can't talk about transition until I say something about ESG in general. Somewhere on the internet, there's videos of me from 2018 talking about the need to profit from these, to find the right investment opportunities, not just simply look at green strategies. And this is very pertinent because, of course, President-elect came out yesterday to say he's going to ban wind farms. So if you're in green investing, you're invested in those types of stocks, you're going to have a difficult time. So Trump is changing the way the US will think about sustainability, and that will affect the rest of the world. But the thing that Eastspring has been doing, we worked with Prudential Group to work on a framework to address the transition. And this is different because a transition is about identifying stocks that don't look green, but can benefit from that journey and can help in that journey. So we've just started to show you the world here in terms of what that means. But Eastspring has finished a transition methodology framework with Prudential Group, with some working with them to invest in that, to deliver a product that identifies the winners and the losers in this transition. So we've just done some analytics. You know, I'm bringing fresh ideas to Taiwan, just done some analytics around this. And I'm very, very encouraged by what I've seen. It kind of typically explains that from the period up to about 2019, there was no premium. So investing in identifying companies that can win in a transition wasn't really extra value or extra return. It was just kind of like a market. In 2020, really there was a strong alpha. And the message is that there was this trend in 2020 that lifted all the boats. All the stocks went up in that space. Lots of different types of strategies did well. In 21, there was a reversal. And certainly in Europe, that was post-COVID for us. We kind of came out of COVID in the middle of 21. And all of the kind of ESG kind of excitement died away a little bit. And I think it's led to disappointment. I was speaking to a client earlier. They had invested in an ESG product. It had underperformed, and they were very disappointed. And really, that's what happened in 21. But what we see with these transition strategies, I expect all of that. But from 22, markets have been rewarding the companies we're identifying as winners in the transition, the companies that are delivering value to the future. There's very interesting work that Eastspring are doing. I'd heard about it before I arrived. I'm even more excited about it now that I've had a chance to talk to the teams. And I think that we in Eastspring hope to bring you some innovations around it. Now, having talked about new innovations, I want to talk about something that is very special to our Taiwan business, and that is the team, the external investment team that run the tech funds. We have a global tech fund, an Asia tech fund. Exceptionally strong investment capability in Taiwan, delivering on a thematic that I don't think is going away. So we've heard about the US markets. We know that S&P investors have been able to, NASDAQ investors are able to benefit greatly from the AI success of a few names in the US. But as we think about the next generation, the next winners, this boom is likely to broaden out. And we have a phenomenal track record in the tech team here in terms of trying to develop and benefit from this long-term trend, as we call it, in terms of how AI can transform us. So it's not just about 7 names, and I'm constantly looking to the future winners. It's going to be about the different kinds of businesses in that space that can win. And tech is clearly a long-term trend that we can all benefit from. How am I doing for time? Got 5 minutes? Great. So key takeaways. Too many words here, but global growth will moderate, and we think that there'll be more volatility and risks in the second half of 2025. So the policies coming in from the administration we're all very familiar with, very much pro-growth, but very potentially also inflation-driven. We don't talk a lot about tariffs, but there is also the narrative on tariffs. I might want to just say that, look, most of what we're learning is that he announces a very strong tariff message, but then it's actually a negotiation. That's how markets have accepted it, as being less of an explicit statement, but more of a sort of a negotiation tactic. So he came out a couple of days ago to say tariffs will not be across the board. They're going to be selective on specific industries. And the thinking is simple. He's won an election very specifically for a US audience, and there are certain industries that he needs to be seen to be protecting. And the rest of the space is very much a trade. Now, no one takes the rest of it very, I heard overnight they want to take over Greenland and mess around with Mexico and Canada. Those are all narratives. I think we as investors should focus on the future. It's very rational that people want to help economic growth as much as possible. Of course, I think it's less wedded to a strong dollar, good for emerging markets. So that message we have is there's volatility. And so if you diversify away into India, into Japan, think about thematics, think about Asian growth. In bonds, think about non-dollar bonds. Be selective on duration. And finally, think about quality, right? And that quality defensive space, it's low volatility, equity, and also income equity. So with that, I might actually pause and say thank you very much.
Thank you so much, Viz, for the really informative presentation. Thank you so much. And please remain on stage as we are collecting some questions from our audience today. 好，非常谢谢 Viz 为我们带来。
Thank you, Viz, for sharing such an insightful presentation with us. We have collected some questions from the audience, so we would like to address the questions with you. So,
collected some questions from the participants, and I would like to ask the first question. What will be the impact of Trump 2.0? For instance, if tariffs continue to rise, could this lead to higher inflation or even a recession? And beyond Trump, what other risks should we be paying attention to?
Yeah. Quite a lot of packed question.
Yeah.
Trying to decompose that. So first we start with tariffs. I think we start with this US presidency, and he's pro-growth, pro-investing. He's pro-markets from Trump 1.0. So there's this expectation. Markets have been fairly benign. And they've been benign because there's an expectation that he's rational. And there's an expectation that he wants to do the deal. And so we've seen some journeys like that. We've seen some very strong announcements. I will do 40% tariff on day one. But in the last week, 2 weeks, we start hearing it's going to be selective. It's on specific industries. And I think most investors will accept that there's a need to also, as an elected president, deliver on some of the pledges around certain industries that he needs to deliver. Now, when it comes to the wider context of Trump 2.0 and the challenges, clearly in Europe, they will be asked to commit 5% of GDP to NATO defense spending. That can't be good in a European context, notwithstanding all the other caveats we have in Europe around the risk of China, exposure to energy. There's quite a lot of challenges in Europe. Now, obviously, I used to be based there. I was talking to a client earlier, and amusingly for me, I was saying, in some ways, UK looks the most interesting because most of the revenues in the UK are abroad. It's kind of an energy-focused index with foreign earnings, which is not the riskiest place to be compared to some of the European countries that export. So there are challenges across the globe. When we come to tariffs and we think of Asia, so far my only learnings I've had has been around currency movements. We see that Mexico tried to be a little bit tougher with Trump, and we saw that the currency markets immediately penalized the peso, which kind of takes us to this idea that you might want to be sort of at least a friend to the administration rather than an enemy. And that's really what a lot of the outlook is talking about. Japan, India, some of the ASEAN markets, these are the places that are likely to be able to get to a deal. Now, global growth is, I think, a slightly different worry because we're seeing an exceptional stock market return, but we're moving to an environment where likely returns are lower. And that's the most plausible statement because we've had such exceptional returns for a number of years. And so with that case, I think we would argue that global growth probably is already going to be challenged in the coming 6 months, 9 months, 12 months. And that takes us to something that's just consistent. I think the biggest worry is some extreme cases where the market hasn't really priced in too much Trump risk, but it turns out to be a bit unexpected and it goes a little bit extreme, right? And there's always that risk with the president. And so we would worry about that as markets. And I would argue that today that's really not priced. And the way the way we actually explain that is to say today, the risk premium in markets are challenged in some of the more traditional successful markets, and you want to think about diversification to deal with the volatility you're likely to see. I hope that answered the question. That was a very big question.
Yeah, thank you, Viz. And here comes the second question. So, what is your outlook for Japan equity market? Japan raised its interest rates last August, and will Japan continue its rate hikes in 2025? Moreover, if the rate hiking happens, will the unwinding of carry trade cause the correction in U.S. stocks again?
Yeah, that was another long question. So we're just playing out what we saw in 2024. So, the unwinding of the yen trade caused quite a lot of turbulence, right? But I think that as investors, you had a minus 12% one day and a plus 9 the other. So that tells us that there's quite a lot of support in the market. I mentioned that in the outlook itself. I think Japan is quite a unique investment opportunity. I think that we worry about the US exceptionalism. What are the numbers? What are the trades? We think Japan is in a really interesting because of quite a developed economy. We've seen some turn. The BOJ is moving to a rate hike cycle because the economy is doing well. It's not because the economy is not doing well. And that improvement in corporate Japan, we expect to see across the cap spectrum. So we're seeing it broaden, and we expect it to be across the rest of the economy. The supply chain argument, again, leads well to Japan. It's got good technology. It's a safe partner to the US. Those are not headwinds necessarily on a relative context. And then we are also seeing corporate Japan expanding a little bit into ASEAN. So there's some interesting opportunities there as well. So again, I re-emphasize what I said on the presentation day. I think Japan looks like a unique opportunity. And Eastspring have got this really interesting strategy that's looking at seeking out these values across the capitalization spectrum.
All right, thank you so much, Viz. 那我们是不是再一次掌声？
Once again, thank you, Viz, for your presentation.
Sharing, thank you, and please kindly take your seats. 我们非常谢谢投资长。
Thank you, Viz, for sharing with us. Before we move on to the next session, allow me to remind you that you can raise your question either filling the question sheet in the welcome packet, or you can submit your question online by scanning the QR code on the back of your badge, and we will receive your questions, and we will try to address your questions as many as we can. And now we would like to turn our focus to fixed income market. Recently, as expectations of rate cuts continue to increase, investment-grade bonds have emerged as a key highlight in asset allocation strategy. Let's welcome Ms. Claire Huang, Head of Client Portfolio Management of Eastspring Taiwan, to provide an in-depth analysis of the current dynamics and investment opportunities in the fixed income market. Let's give her a round of applause. Good afternoon, ladies and gentlemen. Now I would like to turn back to Chinese. So in my presentation, I will focus. You can take off your interpreting headsets. You don't want to listen to my Chinese to be translated into English. Let's focus on the fixed income market. If we look ahead to 2025, we believe that there will be 4 drivers behind the fixed income market. Well, first of all, is the Fed policy or the U.S. rate decision. Will the Fed continue to cut rates in 2025? Because recently, some market participants have been saying that we already have like 3 cuts since September last year. Will the Fed be able to continue to cut rates? So here we can look at a couple of things. First of all, in terms of economic data, in fact, the Fed has 2 mandates. One is fighting inflation, and the other one is promoting economic growth, that is reducing or controlling unemployment rate. And also, we have to focus on Trump 2.0 and its impact on inflation. Another driver, which is even more important, is that if you look back on 2024, yes, what Fed did was important, but more importantly is the market expectations of the Fed decision, and also the gap between the expectation and the Fed's decision. So on the one hand, what Fed did is one thing, and what the market expected was another. And the gap or the differences between the expectations was a key driver for a fixed income market last year. And let's first by looking at some economic data. If we start with inflation numbers, on the left-hand side, we show you the PCE inflation. On the right-hand side is the CPI inflation. Here, you can see there's one thing in common, that is inflation in the U.S. continue to trend down. Whether it's PCE or CPI inflations, they started to decline since the end of 2022. And another thing is that in 2024, the Fed actually preferred to look at the yellow line on the left, that is the core PCE inflation, which is already below 3%. If you look at the FOMC minutes in November or December, the Fed has less discussion on inflation because inflation has been improving. Even though today we again see some stickiness in terms of inflation, but looking ahead to 2025, let's look at this chart. As you can see that this is what sell-side analysts expect from 2025. And market participants expect core PCE inflation will decline to 2.5% from 2.8% last year. So this is a bit different from what we have been hearing from the news programs. Because recently, people once again focusing on inflationary pressure, even though the Fed also believed that inflation will decline to 2.5%. But that number was revised upwards from 2.2%. In other words, the Fed also believed that inflation will trend down, but at a much slower pace in 2025. And now let's look at the labor market. We know that the Fed has dual mandates. One is to fight inflation, and the other mandate is to support growth. And its target range for inflation is 2%. So we need to look at inflation and labor market at the same time. On the right-hand side, this is the U.S. unemployment rate. post-COVID, the U.S. unemployment rate has been very, very low and very, very resilient. And now it has picked up to 4.2% recently. And recently, we have seen a lot of people talking about U.S. businesses laying off their employees. In fact, we do not expect to see a recession in the U.S. economy. We're simply seeing a cooling down in the U.S. labor market, and that's why the Fed was able to cut rates in advance. And looking ahead to 2025, what are the market participants' expectation of unemployment rate? On the right-hand side, you can see that most people believe that the unemployment rate will pick up a little bit. Actually, it's a coincidence that the Fed's expectation for unemployment rate and PCE inflation are identical to market expectations. So well, actually, these numbers have sort of factored in Trump's policy. In fact, inflation will continue to trend down even though at a slower pace, while unemployment rate will pick up. So the Fed will continue to ease its monetary policy. And I think that it is highly unlikely for the Fed to stop cutting rates and raise rate again. It is unlikely to happen in 2025. And now let's look at Trump 2.0. Trump will take office on January 20th. Will Trump do what he said during the campaign? No one knows. So this is, once again, what market participants expect. We know that Trump has been talking about imposing tariffs on all the countries in the world, but this is not what he really wants to do. This is simply a bargaining chip for him. He would like to protect U.S. economy and U.S. interests. Then this is the estimate from Goldman Sachs. On the left-hand side, you can see that if Trump imposes a universal tariff on all the countries, for instance, 60% of tariff on China and 10% tariffs on the rest of the world, which is unlikely, but under that extreme scenario, global growth or GDP growth will suffer a lot. In 2025, it will decline by 0.5%, and in 2026, it will decline by 1.1%. If you look at IMF's estimate, this year, U.S. GDP growth is expected to reach 2.2%. And of course, the Fed, World Bank, they all have their estimates. But most people believe that 2025, the U.S. economy is expected to grow by 2 to 2.5%. And if it drops by 0.8% because of tariffs, and under that extreme scenario, the U.S. economy will face a lot of challenges and risks. And this is not what Donald Trump wants to see. So we do not expect to see an extreme tariff scenario after Donald Trump takes office. It is simply a bargaining chip for Donald Trump. And based on that, if you look at the chart on the right-hand side, this shows you different paths of inflation. Here we have two different scenarios. The blue line is our base case scenario. If Donald Trump only imposes 20% of tariff on China and another 20% on Europe and Mexico's auto industry, that's the basic scenario. Under that circumstances, actually, this is a mild scenario. You can see that, yes, inflation will pick up, but it will be short-lived and still under 3%. And when the U.S. inflation is below 3%, then the Fed's policy will still on track continue to ease the monetary policy. In 2022, the Fed increased interest rate dramatically. And during that period of time, do you still remember the U.S. CPI inflation? It peaked at almost 9%, and PCE peaked at over 7%. As long as the U.S. inflation is still below 3%, the Fed will continue to ease its monetary policy. But of course, under extreme scenarios, which is represented by the red line, of course, it will go above 3%. But based on our base case scenario, we do not believe that Trump would like to see U.S. economy fall into recession. So Trump's policy, yes, will have inflationary pressure on the U.S. economy, but not to the extent to stop the Fed from continuing to cut rates. So this is our base case scenario.
好，那来看一下联准会。
So now let's turn to the Fed. This is actually the dot plot issued by the Fed on the 18th of December. Basically, they are predicting 2 rate cuts by a total of 50 basis points in 2025. However, 2025 is not the end of the rate cut cycle because the Fed is predicting there will be more rate cuts in 2026 and 2027. And in March, the Fed will issue the next dot plot. So that's what we need to pay our attention. So when it comes to the outlook of the bond market in 2025, we need to, first of all, look at whether the rate cutting cycle will continue. Second of all, whether there's any gap between market expectations and the Fed policy, whether I can afford to be more optimistic or more pessimistic. Well, we can call this either lucky or unlucky because if you take a look at this chart, this is actually the Fed fund rate futures. So we look at what is predicted by these futures for the U.S. interest rate. So according to this chart, the predicted rate is between 4 to 4.25%. Right now, it's between 4.5 to 5%. In other words, although there are 50 basis points in the Fed prediction for its rate cut, but actually, according to market expectations, the room for further rate cut is only 25 basis points. That means the market is actually more conservative. Therefore, as a bond investor, this is actually a very good opportunity because it's very seldom that we live in an environment where market is more pessimistic than the Fed. This is the first time, as a matter of fact, over the past 2 years. And this is in September of 2024. Back then, the market was expecting there would be a rate cut of 1.5% in 2025 and 0.75% in 2026. So back then, the market was excessively optimistic, but now we are actually more pessimistic. Therefore, although the market has its expectations, but sometimes expectations tend to overshoot. So right now, we seem to be in the territory of excessive pessimism. However, against the backdrop, this would be a great point for you to invest in investment-grade bond. There are certain characteristics when it comes to investment-grade bond. First of all, we were saying that we believe the rate cutting cycle would continue and the market is very pessimistic. That's why the market actually is very inexpensive. Because we all talk about investment so far, but we probably need to look at both supply and demand side. The demand is actually quite strong because we know that insurance companies are continuing to buy into investment-grade bond. And there is a unique characteristic because each of the companies are doing in terms of profitability. If you build up your portfolio and if all you have is risk assets, then that's very risky. Therefore, you really need to have a bond position in your portfolio so that you have peace of mind so you can sleep better at night. And so when we take a look back in previous rate cutting cycles as compared with U.S. equity and non-investment grade bond, as you can see, investment grade bond typically in 3 years, 5 years after rate cuts, they tend to outperform as compared with U.S. equity or non-investment grade bond. And you can see the chart on top is the yield of the investment grade bond. The higher the yield, the lower the price. I think everybody knows that. However, there's a second meaning of the yield, and that is if you buy into the market right now and you hold your investment until maturity, and this is the total income that is reflected in this chart. And right now, the yield is more than 5%. What does this mean? This means this is a unique opportunity because the last time it's happened was when we were experiencing financial tsunami. And if you go back further, then the previous time when this happened was when dot-com bubble burst. So if you get into the market at this kind of moment, then you will have greater source of income. And whether we look at the bond or equity, obviously we want to buy at a low point and sell at a high point. But it's very difficult to time the equity market. For example, if we take a tech sector, for example, if the tech sector sees their share price drop by 20%, it's very difficult for you to say that's already a bottom. However, if the yield of the investment grade bond is in excess of 5%, then it's pretty safe for you to say that's probably a bottom for bond. So if we look at numbers over the past 20 years, if you get into the market when investment grade bond yield is more than 5%, then you can look at 8% as a total return in 1 year, 16% in 2 years, 24% in 2 years. So if you compare this with when you get into the market when the yield is less than 5%, then the return is actually 2 times as much. So obviously, if we look at the face value of the different bonds, they have a different face value. But if every bond is normalized to 100 face value, because as mentioned, the market is very pessimistic. So right now, for the face value of 100, the last time I checked, the price is only 91.2%. In other words, the bond is being sold at a discount. And if you buy into the market right now, if you hold it for 1 year, 2 years, 3 years, then you can look at the very handsome return. Again, if you compare this to when you buy into the market, when the price is 95 to compared to a 100 face value, your total return will be 2 times as much. In addition to valuation, we also need to look at supply and demand. Obviously, demand is continuing to increase while supply is stable. Why the demand is strong? Because right now, the yield is quite high. So insurance companies, they have liabilities obligations because they sell insurance policies. So they take on the liabilities. That's why they need to buy bonds in order to match their income, match their asset with their liabilities. So year to date, as you can see, there has been net fund inflows into investment grade bond market. And one of the major reasons is the fact that in addition to investors, insurance companies are also buying more and more investment grade bond. What about supply side? Well, in 2025, 2026, 2027, as you can see, a lot of investment grade bond will expire, will mature, and they will pay all the principal and interest payment to their investors, and the bond will be taken off the market. Therefore, as you can see, right now, as compared with 24, we believe that the total outstanding balance of the investment grade bond is actually somewhat lower because some of the bond will mature. And finally, another major characteristics Another major characteristic of investment-grade bond, this has nothing to do with return. Rather, we talk about the fact that it's quite defensive in nature, because 2024 is the year where equity market performed extremely well. If you are an equity investor, it's only a matter of how much your gain has increased. You never talk about incurring loss if you invest in equity. So this is a bull market for equity. But even during a year of a major bull market for the equity, there were still some pullbacks because in April, July, and August turning into September, there were 3 major pullbacks. And especially in April, because at that time people discussed about yield, and that's why the bond, while it fell, but it actually quite limited. But the most important factor is actually the level of valuation. Right now, the level of valuation for equity is quite high, and so if you can add investment-grade bond position into your portfolio, then obviously this can actually provide some downside protection when there is a major correction in the market. In 2025, do we expect the equity market to fall, to pull back? If you don't think the equity market will fall, please raise your hand. Wow, still some of you, probably 4 or 5 of you. So, but we have about 100 people in attendance today. So 5 out of 150 believe the equity market will continue to rise. But the rest, the remaining 145, believe there will be some pullbacks. Well, if you don't believe the equity market will fall, obviously you can put all your investment dollars into equity. However, if you do believe, although at the end of the year the equity market will be higher as compared with the beginning of the year, but there will be some pullbacks in the process, then our recommendation is for you to increase some of your bond position in your portfolio. The reason why investment-grade bond is so trustworthy, well, because the default rate is quite low. On the chart on the left, the bottom curve refers to investment-grade bond, with the exception of what happened in 2008 when we experienced a financial tsunami. As you can see, especially post-pandemic, bond issuing companies are improving their profitability. Therefore, default rate is quite low. I would like to take some time overviewing, providing you with an overview of our bond products. This is our investment-grade bond fund, and our holdings are bond issuing companies with a high credit rating. Our portfolio has a higher average credit rating as compared with benchmark, and the yield is still quite impressive, 5%. As you can see, the top 5 holdings are well-known companies. If you take a look at these companies, you wouldn't say these companies are likely to default. Because of the high credit rating, therefore, volatility is actually quite limited. So perhaps we can provide you with some basic information. Right now, the fund yield is 5% as compared with SMBS or government bond or composite bond. As you can see, our fund rate is quite high. But at the same time, as mentioned, all our holdings are investment-grade bonds. We have very limited allocation to BBB rating. Most of our holdings are A, AA, and AAA. This reflects our fund manager's views. The reason why we have very limited holding in BBB rating because we have limit, and we cannot buy non-investment grade bond. That's why this is actually sort of like a thoroughbred, a pure investment-grade bond fund. And as mentioned earlier, this is our top 10 holdings. I'm sure you all know about these companies. And we actually don't believe any of these companies will default. Given the higher credit rating and the fact that all our holdings are well-known companies, so if you compare our fund to our peers, our volatility is lower than that of our peers. So on the whole, we actually live up to the name of our fund, investment grade bond fund, because we don't invest in any non-investment grade bond. Finally, let me give you a recap. So I've been speaking for about 25 minutes. So let me just summarize what I have been presenting to you. For 2025, there are two things you need to keep in mind when you look at the bond market. First of all, whether or not you believe the rate cutting cycle will continue, or you believe that there will be a reversal. Whether you look at inflation or the market's expectation of inflation, or the real unemployment and the market expectation of unemployment, or how you assess the Trump policy. But we believe overall the rate cutting cycle will continue. Well, as mentioned already, originally the market expected a 1.5% rate cut, but now that number has been coming down. As a result, now the market is becoming more pessimistic. Therefore, market expectations are actually more conservative than what's reflected in the dot plot issued by the Fed, because the market is only expecting one rate cut. So what happened in 2024 will probably not happen in 2025, and that is there will not be a situation where market expect more rate cuts, but they later became disappointed. The reason why we want to buy into investment-grade bond market, because we want to buy at a low point, sell at a high point. If the yield is at 5%. If you do not buy right now, if you wait until the yield drops to 4.8, 4.7, that means if you buy then you will be buy at a higher price. So right now, it's actually a very good time point for you to invest into the market. We talk about a rate cut cycle. We talk about this is a good time point for you to invest in investment-grade bond. Well, bond is different from equity because for a bond, they will be able to provide diversification. Once risk assets in your portfolio experience major correction, then the bond position can help counterbalance that. As mentioned, we are thoroughbred. We are pure investment-grade bond fund, because we only buy bond with high credit rating without sacrificing the yield, because our fund rate is still at 5%. Thank you.
Thank you, Claire, for your insightful presentation. And please stay on stage with us and help us to address the questions that we have selected from our audience. So the first question, in the interest of time, so the first question for you is that the Federal Reserve's rate cuts in 2023 and 24 fell short of expectations in terms of speed and magnitude, and with further easing likely to slow down in 25. So how should we choose between non-investment grade and high-yield bond and an investment-grade bond? So I think, once again, this question has two questions within it. So in terms of how to choose between high-yield and IG debt, well, first of all, you have to know that these are two different asset classes, and also your risk appetite, and also what you already have in the portfolio. For a high-yield debt, it has a shorter duration, roughly 2 to 3 years, and for investment-grade corporates, its duration is about 6 to 8 years. And for a high yield high yield tends to have a higher sensitivity to equity market. When equity market decline, high yield tend to decline even though to a smaller extent. And for investment grade corporates, it tends to provide more stability when equity markets are falling. And right now, IG corporates offer a 5% yield, while high yield is now offering 7 to 8% yield today. So how should we choose between them? First of all, you have to consider your risk appetite and also your current portfolio construction. If you already have a lot of equities in your portfolio, then I would recommend you to include some investment-grade corporates so that to balance your asset allocation. If you already have a lot of high-quality debt in the portfolio, then maybe you can put some money in non-investment-grade corporates in order to once again balance your risk-return profile. And for the first part of the question, it sounds like a complaint about the Fed because the magnitude of rate cuts fell short of expectation. Yes, just like you said, that most people expect to see the Fed cut rates meaningfully in 23 and 24. But what about 2025? In my opinion, a market can go up or go down. But if we start by looking at what are the drivers for market to go down, do you know today's 10-year U.S. Treasury yield? Actually, this already mentioned that. Today's 10-year U.S. Treasury yield is over 4.6%. And in 2023, it used to peak at what level? You remember that? In 2023, October 19, 10-year U.S. Treasury yield was only 1 bips away from 5%. What happened at that time? Do you still remember what happened in October 2023? In 2023, in July, that was the last time the Fed raised interest rate. And in October, people were still wondering if the Fed would continue to raise interest rate. So in 2023, we didn't know if the Fed will continue to raise interest rate. And in November and December, the Fed sent a clear message in terms of the rate cut cycle had come to an end. Today, the 10-year U.S. Treasury yield is over 4.6%. Do you think there's further upside in terms of the 10-year U.S. Treasury yield? Will it return to close to 5%? I think that's quite unlikely. Because today's benchmark rate or Fed funds rate is about 4.25 to 4.5%, which is lower than the Fed funds rate in 2023. So what I'm trying to say is that it is less likely for the 10-year Treasury yield to go up further. But there's still the possibility. We cannot totally rule out the possibility. Because in a panic-driven sell-off, yes, the 10-year U.S. Treasury yield may go up or even breach 5%, but the possibility is quite low. It is not really likely to see the 10-year U.S. Treasury yield to return to close to 5%. That's my opinion. And of course, we cannot expect how much return we can make from investment corporates. But I would like to tell you that it is not practical to expect a 15% of return coming from your IG corporates. But if you consider 2 more rate cuts in 2025 and without any further tail risks, and also considering the average 7-year duration, if you do the math, it is my belief that it is likely to harness a 5% of total return from investment grade this year. But when you invest in investment grade corporates, it's not just about return, but also its defensiveness and stability to the portfolio? Thank you, Claire. The next question, with Trump taking office soon, market concerns about inflation have intensified. Currently, there's a cautious or even pessimistic outlook toward IG debt. How should I manage the investment-grade bond positions I already have? Will there still be opportunities and upside? Well, I think I already answered the question. So let me see if we have other questions from the audience. No further questions? Well, in that case, once again, thank you, Claire, for your brilliant responses and explanations. Thank you, Claire, for your wonderful presentation. And hopefully, we all learned a lot from her presentation. Next, we would like to proceed to our final keynote presentation. And once again, before we start, you can submit your questions either by submitting the questions online or writing down your questions on the question sheet. Next, we are going to delve into the next growth engine for global investments, the Indian equity market. Driven by the global economic transformation and internal reforms, India is now showcasing remarkable growth potential. So, today, we are honored to have Mr. John Ling, the fund manager for Eastspring Indian Equity Fund, and he will provide an expert perspective on the structural advantage and opportunities in India. Let's welcome John. Good afternoon, ladies and gentlemen. I'm pleased to have this opportunity to share with you our views on global economy with a focus on the India equity market. After listening to this and also Claire's presentations, the term that I heard the most, I think, is Donald Trump, right? So obviously, looking ahead to 2025, Trump will be the biggest challenge to investors. But in addition to challenges, there are also opportunities. For instance, markets that have a lower valuations, markets that are undergoing transformations, or markets markets that have underperformed recently. So we do believe that overall, looking ahead to 2025, India has all the attractiveness that I just mentioned, and it will be the highlight or the spotlight in the portfolio. Now, I would like to share with you our views on India. So, if you still remember that during COVID-19 in 2020, India's economy suffered the most during the pandemic. Before 2020, India's GDP growth on average was 7.5%, and in 2020, the pandemic broke out. Its GDP declined by 6.5%, and in 2021, its GDP growth went up to close to 9%, and it declined to 7% the next year, and then it bounced back to over 8% the year after. So India's economic growth has been quite volatile. And under the Modi-led coalition government, we believe that India's GDP growth will transition from a volatile growth to a more stable growth phase. In 2024, in the second half last year, we know that China announced a number of stimulus measures. And before that, Indian equity continued to break record height. But on September 24th, Beijing government announced a number of stimulus measures, and also due to the relative cheap valuations in the Chinese equity markets, within 1 month, we saw a lot of money flowing out of Indian equity market into China, which has led to a huge drawdown in Indian equity market. In September, from September to December, India's GDP growth was only 5.4%. And after 5.4%, which was quite resilient, which put a stop to the equity market decline. Well, actually, it is not because the 5.4% growth rate, it wasn't because the growth rate was stellar. It was actually a recent low. But after that, market participants began to expect higher growth going forward. So we know that investors the investors do not look at the past, they price in the future. So we do expect that in the next few years to come, India's economy will continue to grow at 6%. And here we show you the quarter-over-quarter GDP growth rate annualized. And actually, in the past, India's GDP growth tended to be quite volatile, but it will transition into a more stable growth phase in the years to come. And starting from 2025, India's economy will enter a Goldilocks phase. You guys are all experienced investors, and you all know what is a Goldilocks economy. So I won't spend a lot of time on that. But simply put, starting from 2025, India's GDP growth will remain around 6 to 7% in the years to come. And in terms of inflation on the left-hand side, it will decline from over 5% to around 4%. India's inflation will continue to trend down. And in terms of fiscal deficit, it has declined. It would continue to decline from 5.6% and continue to decline in the years to come. So on the one hand, GDP continued to grow in a stable manner, inflation continued to trend down, as well as fiscal deficit continued to be reduced. So this is what the Modi government would like to achieve. And what are the measures taken by the Modi government to stabilize India's economic growth? We believe that there are two measures. The first source of stability is ongoing reduction in fiscal deficit. Starting from 2021, you can see that India's growth rate was quite high. And during that period of time, Modi government continued to reduce fiscal deficits and improve the government balance sheet. As you can imagine that maybe it's a bit difficult for you to imagine the relationship between fiscal deficit and the GDP growth. Simply put, fiscal deficit is a warning sign. The lower the fiscal deficit, the better the health of the government's balance sheet, right? So as you can see that India's fiscal deficit continues to decline, meaning that India has a much better balance sheet to buffer against external shocks and maintain growth momentum. And also, India's rupee will be more resilient and buffer against, once again, external shocks as well. And how to reduce fiscal deficit? Of course, reduce the money spent by the government, right? But there is one kind of spending that the government is not reducing. That is, the Indian government is still trying to invest in infrastructure. As you can see, that the CAGR of infrastructure investment has been around 17% year over year, because Indian government knows that infrastructure investment is the locomotive of economic growth, just like what China did earlier. Because in the past, China used to invest a lot in infrastructure, which has led to robust economic growth. And as you can see that their infrastructure investment plan is not looking at the next 5 years, but at least 10 or even 20, 25 years. In other words, Indian government will continue to invest in infrastructure at full speed. And with a reduction in government spending, who is going to take the place of the government spending? We believe that private capital expenditure will take the place of government spending. In the past few years, Indian corporates continue to improve their profitability, better profit margin, lower input costs, and also benefiting from supply chain diversification from China to India. Therefore, in the past couple of years, we've seen that India's companies continue to improve its profitability. On the left-hand side, its free cash flow has reached record high, and on the right-hand side, you can see that with abundant free cash flow, Indian companies will be able to pay back their debt either to the debt holders or banks. So with a reduction in on leverage and lower interest cost, so businesses in India have more money or cash at hand to invest in infrastructure or capital expenditure. And that's the first source of economic stability. So the first source of stability is to reduce fiscal deficit. And the second source of economic stability is shifting consumption patterns. In 2010, I started to research Indian market since 2010. And for 5 years, and before that, I also did research on Taiwan and China equities. I spent a lot of time and road trips visiting companies either in Taiwan or China. And when I went to China, we not only went to the first-tier cities, we also went to second, third, or even fourth-tier cities. I went to rural areas. And that I was shocked because we drove miles and miles before we could see one house in the countryside. But after I started to research India and have road trips to India, I was shocked again. Because in India, outside metropolitan areas, infrastructure or rural income or the overall environment was much, much worse than the urban area. And under the Modi-led coalition government, let me give you an example. In Taiwan, our GDP per capita is about $30,000, and China $16,000. But what about India? Less than $3,000 per capita. So in Taiwan, our GDP per capita is 10 times more than India. And the income gap in India is also huge. Together with low GDP per capita and the rural area continue to live in a proper poverty-driven environment. So in other words, in the past few years, in the rural area, the consumption power or disposable income were pretty low. But after the Modi government took office, in the past 10 years, the income gap between urban and rural areas has narrowed meaningfully. As you can see, that the narrowing has been quite obvious. And also, in the past few years, India has undergone a lot of transformations, one of which is the rise of the rural area. In India, women living in the countryside, they don't work. And the job opportunities in the rural areas were either low-end or even no job opportunities. But in the past few years, we are seeing more and more female workers going into the labor market and also increasing production value. And in the past few months, we have seen a growth in rural consumption. If you look at the dark blue bar on the chart, starting from March this year, the dark blue bar has outpaced the light blue bars, which means that the growth in rural consumption has outpaced the overall consumption growth. So relatively, yes, rural areas or the villages in the countryside tend to have less consumption power. Maybe, but there's one thing you need to know, that India continue to push urbanization, continue to modernize its economy, but so far, in India, 70% of India's population still live in the rural area. So once these 70% population begins to increase their consumption, that will be a force to be reckoned with in the future.
So what's the relationship between consumption and investment market? Well, we can take a look back, and this has happened before when there's a major shift in consumer market. For example, in the second quarter of 2020 and the fourth quarter of 1994, those were times when there was a major shift in consumer market. And what happened was that there were a lot of fluctuations in the equity market. This is actually quite understandable because not all companies will all be selling their products in urban areas, because some of them probably will sell more into rural areas while others sell more into urban areas. And for those companies which saw their revenues primarily coming from the urban area, then when the rural community began to rise as a major force in the consumer market, then obviously those companies' share price will fall. And this translates to greater volatility in the equity market. Right now, if we adopt a longer view, volatilities in the equity market will create more room for new investment opportunities. So right now, we are living through another period where the consumer market in India experienced a major shift, and we expect this trend to continue for the next 5 to 10 years, because India has a population of 1.4 billion. As a matter of fact, the most populous country in the world. So right now, India is experiencing urbanization. 35% of its population are now living in big cities. So there is still a lot of room for improvement. Whether we look at fast-moving consumer goods such as shampoo, soaps, or durable goods such as cars or motorcycles. As a result of the rise of the rural communities, we believe that there is great potential for the consumer market of India to continue to do well. So I was talking about the fact that India's GDP will enter into the phase where we will see very stable economic growth. What about our outlook for 2025? Well, the market is expecting inflation will continue to drop. The correlation between inflation and food prices in India is actually quite strong. And the same thing can be said about inflation and oil prices. For example, last year, in terms of total rainfall and the harvest of agricultural products, well, last year actually was a bumper crop year for India because the harvest was quite abundant. this translates to lower food prices. In terms of oil prices, we know that Trump is advocating for traditional energy sources, so oil price will continue to come down. As a result, we believe that inflation in India will continue to fall. And I think that's already a foregone conclusion. So with inflation continue to decline in India, as mentioned by Claire, because in the United States, right now there's a concern. Property inflation decline will not be as rapid as expected. Therefore, this will negatively impact the rate cut policy by the Fed. But as mentioned already, India is in a great position to cut rate 2 times in 2025. There could be more. So 2 times of rate cuts means there will be a 50 basis points reduction in the interest rate. We are not sure how the U.S. market will perform in 2025. And the correlation between India and the U.S. is actually quite low because India is heavily reliant on its domestic market. So domestic market actually accounts for 90% of its economic performance. But the domestic market in the United States, on the other hand, accounts for only 0.2% of the GDP. So whether U.S. economy does well or not, it's almost an irrelevant point for India because the correlation between India and the U.S., historically speaking, has always been very low. U.S. aside, if we look at China, EU, or other economies, basically there are 2 types of events that we need to pay attention to. And that is the movement of the U.S. interest rate as well as the movement of a 10-year Treasury bond in the U.S. Because we believe that it's a very good indicator for how other economies will be affected. But as mentioned already, India is very different because India derived most of its GDP growth from its domestic market. Therefore, it's not very sensitive to the movement of interest rate in the United States. And we know that many markets are experiencing major correction at the moment, including Taiwan as well as United States. The reason why there are greater volatilities now, well, one of the major reasons is actually that the valuation level is already quite high, either historical high or relatively high, because the U.S. equity market rose by 30% in the U.S. Therefore, valuation is already quite high. Therefore, the market actually needs some time to actually consolidate, and investors are requiring higher ROE before they are willing to continue to invest into markets such as the U.S. For example, in the United States, the average ROE in the equity market of the U.S. is about 11%, and in China, due to a lower base, so China is in a very similar situation as compared with Taiwan, about 9%, and the ROE in Japan is 3%. But guess what? The ROE in India is 15% or even higher. As I already mentioned, over the recent years, profitability of the Indian companies is at a historical high, and with inflation coming down, ROE is actually getting higher and higher. So we believe there is a likelihood ROE in India will reach 22%. Do you still remember Warren Buffett? Warren Buffett always looks to ROE as a major metric when he assesses potential investment opportunities. So India, from that particular angle, is a very good choice. And obviously, we also need to pay attention to fund flow. And since 2020, the only exception is probably 2021, when there's a net fund inflow into Taiwan. However, for the majority of time, Taiwanese equity market is a market where there is more selling than buying. The same thing can be said about India. Because a lot of foreign investors believe that in terms of valuation level, the India valuation level is higher as compared with other emerging markets. That's why foreign investors are kind of very conservative when it comes to India. But actually, India's market has been setting new highs year after year, and while foreign investors, for the most part, have stayed on the sidelines. Therefore, just like the situation in Taiwan, the equity market of India is, for the most part, determined by its domestic investors' investment decisions. But now, foreign holding is only 18%, which is a new low. However, as the equity market of India continued to rise, for example, in December of last year, there was a major rise in the Indian market. But for that particular rise, it was mainly contributed by foreign investors. So we believe the Indian people will continue to buy stocks, and there's a likelihood that foreign investors will change mind and begin to invest into India. That obviously will provide more tailwind. And this is Goldman Sachs' prediction for the global market in September of last year. Goldman Sachs was probably one of the earliest fund houses to lower investment ratings for India and upgrade investment ratings for China. Even given that, we actually believe that Goldman Sachs is probably caught in two minds, because right now it's probably considering whether it has made the bad call, and we know that this is likely to change. So now I would like to turn my attention to our fund products. Our India fund is actually investing in sectors such as finance, technology, cyclical consumer good or consumer staples, and you probably have the belief that AI has nothing to do with India. But guess what? Jensen Huang, when he delivered speech on stage, in the backboard, we saw many Indian companies. This goes to show that there is actually a significant sector in India that is AI related. And beginning from 2023, due to market optimism, as well as abundant liquidity, therefore small and mid-cap have outperformed as compared with big caps. However, the gap is beginning to narrow bit by bit. For example, if you look to the chart on the right-hand side, for small and mid-cap valuation, 3/4 actually would contribute by multiple expansion. But for large caps, fundamentals account for more. We know India is characterized by high potential, high growth. Obviously, against that backdrop, small and mid-cap companies will continue to do well. So going forward, we will allocate more of our money into large caps in order to stabilize our fund performance. But we will continue to dynamically adjust our allocation to small and mid-cap companies so that we can create even more alpha for our investors. As compared with our peers, our average valuation of the company that we hold with our fund is actually relatively inexpensive. We believe there will be 5 major challenges. There could be even more. For example, the Trump factor, or whether China will recover or not. And number 3, the impact of AI-related technologies. And number 4, geopolitical risks. And number 5, the market is asking for a higher ROE. So from the perspective of India, as a matter of fact, we believe there are good strategies for India to adopt. For example, India has a strong domestic market. Correlation with U.S. and global market is quite low, and the India is also a country where AI is about to take off. And right now, geopolitical speaking, India is positioned well because it can balance the power among different countries. And right now, India benefit from higher ROE and lower leveraging ratio. Therefore, against the backdrop of higher uncertainties globally, we believe India is one of the best choices for the investors. That concludes my presentation. Thank you. Thank you very much, Mr. Zhang Lin. Again, please remain on stage because we do have some questions for you from our audience. So, question number 1. We know that there has been a major rise in equity market of India. There was a correction in the fourth quarter of 2024. Do we need to worry about equities in India are getting too expensive? And there seems to be no significant AI sector which can support the further performance of the equity market. Isn't that the case? Well, let me respond to the second part of the question. Well, as I mentioned already, there are some Indian companies which are already getting involved in the AI sector right now. There is a joke or story circling around in the investment market. There's a chicken farmer. This farmer takes its chicken to be on a food hunting trip, but some of the chicken fell into the lake. So some people ask the farmer, did you the chicken you lost to the lake, whether it's made of gold or not? But the farmer was very honest. No, the chicken for gold was not mine. But guess what? Another farmer, because the chicken farmer was rewarded handsomely by the goddess of the lake. So another farmer, which is a farmer of ducks, tried to do the same, but when the ducks fell into the lake, he claimed his ducks were made of gold. That's a lie, so he was punished. I'm telling you this story is because for India's economy development, basically they don't just rely on one particular sector. They actually are a well-diversified economy. This is something that can provide investors with peace of mind. That's why we are recommending the Indian market to you. Thank you so much. And question number 2. Again, Trump is everywhere. We believe that Trump policy will lead to strengthening U.S. dollar. This is negative to emerging market, including India. Isn't that the case? Well, as I already mentioned in my presentation, when we look at the correlation between India and the U.S., we believe, historically speaking, that has always been very low. In other words, India is a market of its own. Therefore, in addition to the organic growth of the domestic market, Indian government can also adopt stimulus policies, and there are a lot of policy measures the government can do in order to lower interest rate, to stabilize its currency. Therefore, we believe that in 2025, we believe this will be a year of uncertainties. We believe India will be a safe harbor for investors around the globe. We know that certain policies will sometimes result in market uncertainties and vice versa. For example, we know that China has very clear policies toward not all toward North Korea, but there is still a lot of uncertainties that still come to pass. For example, Trump. The rise of Trump is a major uncertainty. Therefore, we believe that people are looking for ways to hedge against their investment risks. That's why people go back to U.S. market, U.S. dollar, or people now will probably consider India because, as mentioned, given the rising fluctuation of the global market, we believe India could be a major safe haven, safe harbor for investors. Thank you very much. Please give another round of applause to Mr. John Lin. Today, as our seminar is drawing to the close, we'd like to invite all distinguished to come up to the stage. First of all, Ms. Polly Wan, head of Greater China and CEO of Eastspring Taiwan,
is on stage for a group photo. 我们欢迎汉雅投资新加坡的投资长 Viz. Thank you.
And also, we'd like to invite Claire Huang, head of Client Portfolio Management, Eastspring Taiwan. Finally, okay, because Mr. John Ling is already on stage, so it's time for the group photo. Please look at the photographer in the back of the room.
好，让我们先看一下摄影师。
3, 2, 1. Now let everybody do a thumbs up. Again, do not forget to look into the camera. Finally, I also would like to join in the picture because we would like to all do a thumbs up for our seminar today. Once again, thank you so much for being with us at this seminar. This is our Investment Outlook Seminar for 2025. Once again, we'd like to thank all our speakers, our distinguished guests. Please return to your seat. Thank you so much for joining us today. Hopefully, after listening to our presentations, now you have a better idea about how you can identify great investment opportunities against the backdrop of uncertainties. And please do not forget to help fill out our questionnaire. You can either fill out our paper questionnaire or you can submit your questionnaire online. And you will be given a complimentary issue of CommonWealth Magazine. And obviously, we haven't answered all the questions. For example, a lot of questions were submitted online, but we will try to respond to your questions after the meeting. After our seminar, again, we hope we have provided you with some information as you consider your investment strategy in 2025. Great success with your investment in 2025. Thank you.